You find a house for $87,000, needs $35,000 in work. After repair value is $195,000. You can flip this and walk away with $48,000 profit in 90 days. One problem, you need to close in 8 days or the seller moves on. You call your bank. They ask for 2 years of tax returns, 3 months of pay stubs, proof of reserves, and a credit check. Then they send an appraiser who's never held a hammer to decide if your deal makes sense. 4 weeks later, they say no because the property has foundation issues and doesn't meet their lending guidelines. That deal just died. Not because it was bad, because banks don't fund opportunity, they fund paperwork. Here's what changes everything. Private money. A private lender is a person with $150,000 sitting in a savings account earning 4%. That's $6,000 a year. You offer them 10% annually, secured by a real property lien. That's $15,000 a year on the same money. They don't ask for your W-2, they ask about the deal. Banks take 30 to 45 days, private lenders close in a week. I've closed in 3 days when the deal was strong and the lender knew my track record. But speed isn't even the biggest advantage. Flexibility is. Banks use rigid formulas, loan-to-value ratios, debt-to-income calculations, appraisal comps from properties that have nothing to do with yours. A bank won't touch a house with a condemned notice. A private lender who trusts you will because they understand after-repair value and they've seen you execute before. Banks lend based on forms. Private lenders lend based on judgment. That's why your pitch to a private lender isn't, I need to borrow money. It's, I have an investment opportunity that pays you 10% annually, secured by a first position lien on a property worth $195,000 after repairs. See the difference? You're not asking for help, you're offering a return. Now here's where most people stumble. They pitch the opportunity, but they can't back it with numbers. The lender asks reasonable questions and you're fumbling with a napkin sketch and rough estimates. That doesn't build confidence. This is where Mantis underwriting reports flip the script. You pull the property, run the comps, input the repair scope. The system generates a full financial analysis showing ARV, projected profit, timeline, and return on investment. It even calculates what your lender earns at different interest rates, so you can show them exactly what 10% looks like in real dollars over 6 months versus 12 months. You hand that document to a potential lender, and suddenly you're not pitching. You're presenting. They're looking at data, not a dream. Here's the play. Start with one lender and one deal. Close on time. Deliver the return you promised. That lender will fund your next 5 deals without you asking. Because private money flows toward reliability, not just opportunity. Banks slow you down. Private money speeds you up. Banks say no to good deals. Private lenders say yes to good operators. Next lesson, we're talking about where you actually find these people because they're closer than you think.